Friday, the 14th of August, 2026, and the British pound is doing something genuinely strange. It is refusing to move. UOB's latest note says cable, the pound against the dollar, is locked in tight ranges, hovering either side of the 1.3500 level. Just 2 days ago, UOB analysts Quek, Leang and Lee Su and saw price action confined between 1.3493 and 1.3515. That is a band barely 22 pips wide. In a market that can swing dozens of pips in minutes, this is a coiled spring. The pound is effectively paralyzed at a psychological barrier. So why is this happening, and what does it tell us about the next move? Let us step back. The US dollar has just hit a 7-week low after July's non-farm payrolls unexpectedly fell and the unemployment rate ticked higher. Weak jobs data normally pushes the dollar down, and that should have given sterling a clear tailwind. Yet the pound has not broken higher. The reason sits on the UK side. Recent GDP and industrial production figures were mixed, so traders have no strong domestic excuse to buy the pound aggressively. FXCM reported sterling did edge up around 0.29% on Friday, but it remains sideways, unable to decisively crack 1.3500. UOB has now formalized that view. This is a range trading environment, and the range persists until proven otherwise. For UK businesses and holidaymakers, this paralysis has real meaning. A tightly bound pound near 1.3500 means imported goods and energy costs are not getting cheaper, while exporters see no clear competitive advantage. For traders, the narrow band is a scalper's market but a trend follower's frustration. The key psychological level of 1.3500 is acting as a ceiling, not a launchpad. The dollar's weakness is genuine, but the pound is not converting it into gains because uncertainty around the Bank of England's policy path and Britain's growth picture keeps buyers hesitant. That is exactly why the pair is squeezing rather than trending. So where does this go next? UOB points to range trade with upside risk watched. In plain terms, a daily close above 1.3515 would likely open the door to the next resistance, while a break below 1.3493 would mean the range has failed to the downside. The trigger is likely to come from upcoming UK or US economic data, but as of today neither side is giving a clear signal. Until one side wins, expect more of the same, shallow rallies being sold and shallow dips being bought around the 1.3500 midpoint. The pound is waiting for a catalyst, and right now that catalyst is simply not there. So today's takeaway is simple. The pound is not weak, and it is not strong, it is stuck. A dollar trading at 7-week lows should have handed cable a tailwind, but mixed UK data has neutralized it. Watch 1.3493 and 1.3515. A decisive breakout side that band tells you where the next trend begins. Until then, do not mistake stillness for safety. The longer a market coils in a range this tight, the sharper the eventual breakout tends to be. If you are trading this pair, patience is the position. I will keep you updated as soon as that range breaks.